Okay, everyone, you know what? There are two ways that you can measure GDP growth: income, expenditures. So how much money is coming into the economy's coffers? That happens to be income. And how much money is going out? Expenditures. So in theory, it should all add up to zero, right? Guess what? Today's number did not. Income was higher than expenditures, and that could mean this economy is about to go gangbusters. Here to explain why is John Ryding, chief economist and co-founder of RDQ Economics. Still with us, Neil Grossman, chief investment officer at TKNG Capital Partners. John, great to see you. Tell us what's going on here.
Good to see you. Well, for any household, income can exceed spending, but for the economy, they're supposed to be the same, as you pointed out. And if you dig in the GDP report, we see the fourth quarter on the income side, not a figure that gets published in the headlines, but we got the first number because of the corporate profits Neil referred to earlier about. That was 4.4% real economic growth in the fourth quarter on the income estimate. Since the beginning of the recovery, in the second quarter of 2009, the income estimate puts GDP growth at 3% versus the 2.4% on the expenditure estimate. And it's the expenditure estimate that Bernanke has been focused on in talking about the slow pace of the recovery.
Okay, but let's talk about what this means. In other words, you've got more income at this point than you have expenditure.
Well, in principle, those should be the same. What I'm saying is that if you measure the growth of the economy by looking at the incomes that labor and capital generate versus the strength of the economy as measured by what people spend and companies spend, the first is greater than the second, and substantially so. And what's interesting...
And so this means, you know, for next quarter, for the following quarter, it could have a significant impact.
It means we may have more momentum than the GDP numbers have suggested, because an alternative measure shows greater strength. And if you say, does this make strength? Sure. The unemployment rate has come down more, as the chairman explained in his speech to the National Association of Business Economists, more than you can explain by GDP. Well, if you put in this other measure of GDP, it's much more understandable. And also, interestingly enough, the Fed researcher has shown that the income estimate is a better measure of GDP when it gets published. If it's more than a percentage point higher than the expenditure estimate, that's an indication that the growth numbers are going to be revised up. So,
Neil, are you as excited about this as John is?
Well, I think that's one of the reasons the economy has done a lot better. In fact, I think one of the points that John is making, the BLS actually raised the number of the people employed last year significantly in the January revision, which goes hand in hand with explaining why there was a lot more income.
Okay, so why is the Fed so worried then?
Because they want to keep the rates easy. I mean, I think they work backwards. They don't want to raise, so they try and point to the facts that will support their position.
So it's, in other words, they know the answer they want to get.
I agree. There is a big element of that. The other reason they're worried is because of the high level of unemployment. Let's face it, unemployment's high, but it has fallen more than most of us thought it was going to fall over the last year. And if that trend continues, you could get to the point where all of a sudden the Fed finds themselves significantly behind. We're still at crisis level of interest rates, a crisis level of the balance sheet, and it may be that underlying economic developments are running ahead of the Fed's expectations.
But let's talk this through. So if, in fact, the Fed has this flat out wrong and that the economy is improving, what kind of potential bubble could be brewing? I mean, we've seen the Fed get this very wrong before, right?
For the last
10
years.
Spend and housing and all the problems that led to down the road. What kind of problems could lead could we be led to?
Well, you start. Inappropriate interest rate levels lead to inappropriate risk taking. It leads to inappropriate distortion of allocation of resources. People begin to do things that they shouldn't do. You get potential for things like sharp rises in commodity prices, dollar effects. And of course, the biggest risks are going to be what happens with interest rates if people aren't prepared and, you end up really slamming on the economy.
Would this perhaps help explain why we've seen such a rise in the stock market despite all this concern in the bond market?
Well, I think the concern in the bond market, actually, I think the bond market is valuing companies more highly than the stock market is. And I think the stock market's a bit of a safer place to actually be at the present time if the Fed is in the wrong position. Because if you think about it, high-quality bonds are yielding about 5%. That's a P ratio of around 20. Now, we're talking about historical Ps in the 70s. Interest rates are very high in the 70s right now. So right now, I think that what the equity market is saying is that stocks are somewhat undervalued here. And the Fed is going to keep the liquidity going. Whatever Neil might think, whatever I might think, the Fed seems committed to this path. But there may be some clues come April 25th, when we get the new set of interest rate expectations from the various members of the FOMC to see if there's any shifting of some of the members to maybe not waiting as late as 2014. I think the Fed's going to... Bernanke may want to do that. I think he's going to struggle to get to late 2014.
One of the things that I find fascinating is that he's said all along, I'm going to wait till 2014. Rates not going up till 2014. And the stock market, reads a lot into that, likes the sound of that. Of course, that's part of the reason for the rally that we've seen. But he'll move, one would assume, theoretically, as soon as he needs to move. So he can say one thing and do another.
Well, I think he's actually said, they've all said that, look, this is not a commitment, so to speak, but this is our best guess of what we're going to be doing, and we believe we have the fundamental support for that. However, I think that's the problem, is that, look, central banking is a long-term process. They tend to be glacial ideologically, and this particular central bank tends to be much more almost trading oriented at this point. And that's not really what you want out there. You need to be thinking 3, 4, 6 quarters ahead.
John, before we go, what's your biggest criticism of Bernanke and the Fed right now?
Well, I think it's this view that we need to reflate the housing market through very low rates. It was in his lecture today. That's his major concern about the slow recovery. We have a weak housing market right now because we've simply got too many houses. And I don't think you can reflate that through keeping
just let those
low.
housing prices go down and you'll see people going in to buy them, right?
By the way, Matt, you don't want housing prices going up when people can't afford to buy them in any event. All you're going to do is transfer the problem to the new buyer.
All right. We have to leave it there. Our thanks to John Ryding, chief economist and co-founder of RDQ Economics. And Neil Grossman, thank you so much for being our guest host today. It was a pleasure. We hope to see you back, both of you back,